Bitcoin is knocking on the door of another historic move. Price volatility has collapsed. On-chain metrics are flashing mid-cycle strength. Institutional demand is accelerating. And yet, most people still feel strangely disengaged. That disconnect is exactly what makes this moment so important. Because when volatility disappears like this, it never lasts. Historically, periods of extreme calm in Bitcoin are followed by explosive moves, sometimes down, but far more often, when the broader structure is strong, violently up. The question isn't whether Bitcoin is about to move. The question is whether you're positioned correctly when it does. Today, I want to walk you through why the conditions are quietly lining up for what could become a generational Bitcoin surge, and why waiting for perfect clarity might be the biggest risk of all. Don't forget to drop a like on the video and subscribe for more content like this. Now, let's start with what we're seeing right now. Bitcoin has spent the last several weeks grinding sideways after a sharp expansion earlier in the year. Price action has been choppy, volatility is dried up, and sentiment feels oddly muted considering where we are. Traders have largely placed their bets, leverage has been flushed, and now the market is coiling. This kind of environment frustrates people. It feels boring, it feels indecisive. But historically, this is exactly what strength looks like before continuation. Markets don't go straight up forever. They breathe, they reset, they transfer coins from impatient hands to stronger ones. And right now, that transfer appears to be happening again. Short-term liquidations cleared excess leverage, open interest normalized, funding rates cooled off. In other words, the market did the work it needed to do to continue higher. Not tomorrow, not on a precise date, but structurally. There's no mystery about what's driving the bigger picture. This cycle is not being fueled by retail speculation. It's being driven by balance sheets, corporate treasuries, institutional allocation strategies, long-duration capital that isn't flipping in and out based on headlines. We've now entered an era where companies are no longer asking if Bitcoin belongs on their balance sheet, but how much exposure makes sense, and more importantly, how fast they can move before everyone else does. Some firms have already begun. Others are still preparing. Audits, approvals, capital raises, structural delays, which means the demand you're seeing today may only be the first wave. That's a crucial point most people are missing. A significant portion of potential institutional buyers haven't even started accumulating yet. They're not late, they're not early, they're simply not active yet. And when that switch flips, it doesn't happen slowly. This is why the current calm is so deceptive. It feels like nothing is happening, but under the surface, positioning is taking place, infrastructure is being built, capital is being readied, and once that capital starts flowing, the market doesn't politely wait. Now, a lot of people are fixated on one specific catalyst: government adoption, strategic reserves, sovereign wealth funds. And yes, if those things happen, they would absolutely act as accelerants. They would validate Bitcoin at the highest levels of global finance and force a repricing. But here's the key question we need to ask honestly. Does Bitcoin actually need any of that? The answer, historically, is no. Bitcoin has been monetizing for over a decade without governments buying it, without institutions embracing it, without political support. It grew because it solved a problem: a broken monetary system, constant debasement, a lack of credible long-term savings vehicles. That core thesis hasn't changed. Bitcoin remains the hardest, scarcest, most secure form of money ever created. Its supply is fixed, its issuance is predictable, and its network continues to grow stronger with time. As long as global debt expands, currencies are diluted, and people look for ways to preserve purchasing power, Bitcoin's role remains intact. So while headlines about adoption matter, they are not prerequisites. This is important because tying your conviction to one announcement is dangerous. Markets love to hype narratives, and they love to punish disappointment. If expectations run too far ahead of reality, even good news can trigger short-term volatility. But that doesn't change the long-term trajectory. In fact, one of the most underappreciated developments this cycle is how resilient Bitcoin has become. Institutional products, long-term holders, and reduced reflexive selling have all contributed to a market structure that behaves differently than in the past. Dips are being absorbed faster, sell-offs are being met with demand, and sideways periods are lasting longer. This is what maturation looks like. Another signal worth paying attention to is relative performance. Bitcoin has increasingly distinguished itself from the broader crypto market. Dominance has risen, capital has concentrated. Investors understand Bitcoin in a way they don't understand most other digital assets. That separation matters. It suggests Bitcoin is no longer being treated as just another speculative trade, but as its own asset class, something that stands apart, something people hold not for quick gains, but for long-term conviction. And yet, despite all of this, retail interest remains conspicuously absent. There's no mainstream hype, no cultural mania, no flood of newcomers chasing price. In fact, most everyday people still feel either disconnected from Bitcoin or convinced they've already missed it. That absence is not bearish, it's bullish. Historically, true market tops are loud, euphoric, obvious. Everyone is talking about price. Everyone feels smart. We are nowhere near that environment today. Instead, what we're seeing is quiet accumulation alongside widespread skepticism and fatigue. Part of that comes from unit bias. A six-figure Bitcoin feels psychologically expensive, even though market cap and adoption matter far more than nominal price. And part of it comes from something deeper, a broader cultural pessimism about the future. Many people today feel like the system isn't working for them. Wages lag, costs rise, opportunities feel out of reach. In that environment, speculation and gambling become more appealing than disciplined saving. You can see it everywhere. Short-term trades, meme assets, lottery-like bets, the promise of instant escape. Bitcoin offers a different path. Not excitement, not adrenaline, but durability. A way to opt out of a system that erodes value over time. A way to lower time preference and focus on building something lasting. That message doesn't spread as fast as hype, but it spreads deeper. And it's often only fully understood in hindsight. Right now, Bitcoin is still a relatively small piece of global capital. Compared to traditional stores of value, its footprint remains modest, which means the room for growth is still enormous, even after everything we've seen so far. This is why metrics that measure cycle positioning continue to matter. On-chain indicators that track how far prices moved relative to long-term holder cost bases show we're not in euphoric territory. We're in a zone that historically precedes further expansion. Not a guarantee, not a straight line, but a favorable setup. Long-term trend channels tell a similar story. Bitcoin has spent most of its existence climbing within broad upward bands. Previous cycles did not end without price pushing into higher ranges, and while no model is perfect, the historical pattern suggests we may still be early in the larger move. Of course, markets don't care about our timelines. Short-term pullbacks are always possible. Sharp moves down can happen without warning. That's the price of volatility. But risk works both ways. The greater risk for many people may not be a temporary drawdown, but remaining underexposed during a structural repricing that unfolds faster than expected. This is how generational moves happen. Not when everyone agrees, not when certainty is obvious, but when conviction quietly builds while most people remain unsure. Gradually, then suddenly. Capital floods in, sellers dry up, price gaps higher, and those waiting for confirmation find themselves chasing strength rather than benefiting from it. That doesn't mean reckless behavior. It doesn't mean over-leveraging. It means understanding the asymmetry of the moment. Bitcoin doesn't need perfect conditions to move higher. It doesn't need unanimous belief. It doesn't need permission. It simply needs time. And right now, time appears to be on its side.
So if you're thinking about how to position yourself, think less about headlines and more about fundamentals, less about timing the perfect entry and more about whether you want exposure at all, less about short-term noise and more about long-term trajectory. Because opportunities like this don't announce themselves loudly, they whisper. And by the time they become obvious, the best positioning is already behind you. We may look back on this period not as the top, not as the end, but as the early stages of a much larger repricing, one that rewards patience, conviction, and a clear understanding of what Bitcoin actually represents. A generational surge doesn't feel dramatic while it's forming. It feels uneventful, underwhelming, easy to ignore, until it isn't. So position yourself thoughtfully, stay humble, stay disciplined, and remember, this market doesn't move on your schedule. But when it moves, it tends to move fast. Remember, secure your keys, think long-term, and stay focused. Don't forget to drop a like on the video and subscribe for more. See you in the next one.